Hey everyone, welcome back to Corporate Decoder, the place where we unpack the hidden stories within financial filings. And today we're diving into the Bank of New York Mellon's second quarter 2025 report, where things are a bit more complex than usual, with some major shifts we need to talk about. Before we dive in, make sure you're subscribed, and if you love getting these kinds of deep dives into corporate documents, hit that like button, and consider joining our Discord community, linked down below for even more exclusive content and discussions. Alright, let's get straight to it. BNY Mellon, a giant in the financial world, is showing us a pretty interesting picture for the second quarter of 2025. Looking at the highlights here, net income applicable to common shareholders jumped to $1,391 million. That's a nice bump from $1,143 million in the same quarter last year. Diluted earnings per share followed suit, hitting $1.93 compared to $1.52 last year. This is what we like to see. Profits are moving up. Now let's look at where that money is coming from. Total fee and other revenue landed at $3,825 million, a solid increase of 7% compared to last year. Fee revenue itself is up 7% too, largely thanks to more business, higher market values, and more client activity. This is a big deal for BNY, as fee revenue makes up a huge chunk of their earnings, around 72% this quarter. Then there's net interest income, which saw a significant jump of 17% compared to last year, reaching $23 million. This boost is thanks to them reinvesting their money securities at higher interest rates and growing their balance sheet. Think of it like getting paid more interest on your savings account because rates went up. On the metric side, their assets under custody and administration, or AUC, hit $5.8 trillion. That's up 13% from last year. This is like managing more money for more people and companies, a huge sign of trust. Assets under management, or AUM, also grew to $2.1 trillion. Let's touch on their capital health. Their common equity tier 1 ratio, a key measure of a bank's financial strength, is solid at 11.9% under one method and 11.5% under another. These are comfortably above the minimum required levels, which is good news for their stability. Now, a bit of a caution flag. An interim goodwill impairment test for their investment management unit flagged that its fair value was only about 11% higher than its recorded value. While no impairment charge was taken, this means that unit's value is quite sensitive. A small worsening in market conditions or a slight increase in interest rates could create a problem there. BNY operates globally, and while they manage risks, their top exposures outside the US are in countries like Germany and the UK, with Germany representing $21.0 billion worth of exposure. They're also keeping an eye on Brazil and Russia, though their exposure there is much smaller. Looking at their securities portfolio, which is a big part of their assets, about 97% of it is rated investment grade or higher. This is generally positive, showing they're invested in relatively safe assets. However, they did have a net unrealized loss of $4.4 billion in their portfolio, mainly due to interest rate changes. Their loan portfolio reached $73.1 billion. The largest concentrations are still in financial institutions and commercial real estate, making up a big chunk of their credit exposure. They highlight that 96% of their financial institution exposures are considered investment grade, which is a good sign for quality. Their allowance for credit losses, which is money set aside for potential bad loans, decreased to $37 million. This is a positive sign, possibly indicating improved credit quality or specific reserve releases, especially in their commercial real estate portfolio, where they saw a benefit of $17 million and well as this quarter. The Market and Wealth Services segment showed strong revenue growth, up 13% year over year to $1,742 million. Pershing, their brokerage services arm, saw an 11% increase in revenue, mainly from higher net interest income and client activity. In the Security Services segment, Accession rose 12% to $40 trillion. This growth, driven by market values and client inflows, is crucial for BNY, as it often leads to more fee-generating business down the line. However, the Investment and Wealth Management segment experienced a 3% revenue drop compared to last year, mainly due to a shift by clients towards lower fee products and a change in how some rebate agreements are accounted for. On the expense side, total non-interest expense increased 4% year over year to $3,206 million. This rise is mainly due to higher investments in technology and employees, plus some unfavorable currency impacts. Looking at regulatory changes, the Federal Reserve proposed some updates to capital rules that BNY believes won't significantly impact their capital requirements, which is definitely a relief. Another interesting point is their derivative contracts. Some of these have clauses that could trigger extra collateral demands or contract terminations if their credit rating drops. The potential exposure in a worst case scenario, if their rating were to fall to a certain level, could be around $1,628 million, though this is highly unlikely. BNY actively manages interest rate risk, and their models show that if interest rates were to rise by 1%, their net interest income would increase by $94 million. On the flip side, a 1% drop in rates would decrease it by $182 million, showing how sensitive their earnings are to rate movements. Now, looking at BNY Mellon as a whole, they're showing solid revenue growth, especially in fee-based businesses, which is a strength. Their capital position remains strong, and they're returning capital to shareholders through dividends and buybacks. However, the sensitivity of their investment management unit's goodwill and the pressure on fees in that segment are areas to watch. Their massive scale in AUC Kun and Om provides a strong foundation, but the overall economic climate and interest rate environment will continue to play a big role in their profitability. It's a massive complex business, and they seem to be navigating it relatively well, but constant vigilance is key. What are your thoughts on BNY Mellon's latest performance and their outlook? Let me know in the comments below if you found this breakdown helpful. Please hit that like button and subscribe for more. And don't forget there's a link to our Discord in the description if you want to connect with us and discuss these things further. Thanks for watching, and I'll see you in the next one.